Okay, this is a continuation of part one. So this is part two. Um, we're looking at chapter two, the recording process, and this is part two, the presentation. I want to reiterate that this presentation has been prepared from slides from John Wiley and Sons, from slides from McGraw-Hill, and then also some information. I created additional slides myself, um, and the source of one of them is from the Journal of Accountancy. And you'll see down below each slide where the source is. We finished up with this review question, so let's continue. Now we know in your textbook, they discuss the analyzing and reporting process. Step one is we're going to analyze each transaction and event from our source documents. Source documents meaning from an invoice or from a contract, but you'll look at that transaction, that event, that economic event, and then decide whether you need to report a transaction. The next step will be to record the transaction and events, and it's known as journalizing. So first you're going to analyze, then you're going to journalize, and then we'll post, meaning we're going to take those journal entries and post them to the ledger accounts. Again, going back to that T account, that's an example of a ledger account. And then from that, we'll prepare and analyze the trial balance. So those are our steps. The process is actually the three, so you want to know this for multiple choice, right? You're going to analyze a transaction, then you will journalize that transaction in the general journal, and then you will post that transaction to the general ledger, and from that then we'll prepare a trial balance. Okay, let's continue. Now if you remember, I did give you a chart of accounts. The numbers off to the side, here's an example of a chart of accounts. The numbers off to the side for each account is so it makes it easier when you're entering into a software. Instead of typing out the account title that you want to debit or credit, you'll just put that account number in, and that will the software knows to retrieve that account. A chart of accounts is a list of all the accounts being used in your software or for your company, and it will be particular to your company. The ledger will be the collection of all the accounts giving you the detail. Remember when I told you the T account is an example of a general ledger detail of an account. All right, let me show you specific examples. Again, a chart of accounts just lists the accounts for you. So that would be the first thing. If you're starting at a new place of business, you want to look at their listing of accounts. What accounts do you guys use? And so you would request a chart of accounts. All right, this is where we will journalize transactions. And if you remember in class, I had shown you a pad or a little piece of paper where we, in practice, we used to enter our journal entries. And then somebody would actually record them into the software. But journalizing transactions, this is exactly what it looks like, right? We have the transaction date. We have the titles that we're affecting. You're going to list your debits first, then your credits. Then we have the dollar amounts. And remember, for every transaction, when you're journalizing a transaction, or the term may be to prepare journal entries, your debits and credits must equal. That's the double entry accounting system. So debits equal credits. My debits equal 30,000, my credits equal 30,000. So this transaction is good to go. And then finally, you're going to put an explanation. Why are you creating this journal entry? Why are you journalizing this transaction, this event? Then, with that, we've just journalized the transaction. Now we're going to post. And like I told you, T accounts, that's a quick and simple way to reflect the detail of an account in the ledger. And It says here useful illustrations, but in practice we're going to use a 3-column form of accounts. And here's your example. On the left you have the date, then you're going to have the explanation, then you'll have the debits or credits and the eventual balance in the account. This detail is of the cash account. So as the owner of a business, you may go to the accountant and say, you know what, print me out a detail, general ledger detail for the cash account from January 1st through to June 30th. I want to see where we're at as of June 30th, and I want to see all the transactions that have hit this account. And that's exactly what would be printed out. In this example, they're just showing you December transactions. That first one was the initial investment in this company. There's the a debit of $30,000. Cash is coming into the business. Remember, cash, the normal balance would be a debit. Cash is an asset. Assets are on the left side of the equation. Left means debit. Here we purchased supplies on December 2nd at $2,500. I'm purchasing, cash is going out of my business. So there's the $2,500 being removed from the business, from this cash account. If I was the owner, I would look at this and say, okay, on December 3rd, we purchased equipment of $26,000. What equipment did we purchase? I want to see it. I want to physically see it. I want to know exactly what that was, who the vendor was, and why that cash went out. This I made a copy of. This is the actual transaction entry screen for the place where I work at. This is the software that we use. You can see here's the journal entry number, 12,591 off to the left. There's the batch ID. That's the person who's entering this journal entry. There's the transaction date, the reference, the source document, I'm sorry, let me keep going. Transaction type, standard or reversing. We'll get into that later. This is just a standard journal entry. There's the source document. It's a general journal. Just remember that. General journal is where we journalize transactions. General ledger is where we post them. There's the reference or the explanation. RCLSS means reclass. In our terminology, it's just shorthand. And she's reclassing this invoice payment. There's the account numbers. And there's the amount. My debit equals my credits. Notice with a software, if your debits do not equal your credits, you're going to have a difference down below. See, the difference is 0. I'm good to go. This software will actually have a check, and it'll say, you know, it will not allow you to save this transaction unless your debits equal your credits. It's a control. So there's an actual transaction entry screen, and then this would be the detail. If I asked for the detail of this account, this is the prepaid insurance, this is off of our general ledger system. And you can see all the transactions that have been posted to this account for the period from July 1st, 2006 to June 30th, 2007. And like I said, this is an actual general ledger detail for the prepaid insurance account for this time period. Notice the dates, right? You have a date for this transaction. The first one is October 19, 2006. There's the journal entry number. I can always pull up that journal entry now. There's the source, GJ, General Journal. And then what we're doing is we're crediting the insurance account. Remember, prepaid means asset. So if I'm crediting it, I'm reducing an asset account. Let's look at another source document. The next one, October 30th, gives me the source as a pwrpt. That's from our payables transaction software application. So we have a payables person that will actually enter invoices, and when she pays them, it'll hit the applicable accounts. So now I know that that's that source document. But anyway, that's the general ledger transaction detail. All right, let's quickly look at a review question. Posting. Posting normally occurs before journalizing? No. Right? We journalize first and then we post, so it's not A. Transfer ledger transaction data. to the journal? No, we transfer from the journal to the ledger, so it's not B. C, posting is an optional step. No, it's not. We have journalizing, right? First you're going to analyze a transaction, then you're going to journalize, then you're going to post. So the correct answer is D, transfers journal entries to the ledger accounts. All right, we're going to stop here and continue with part 3.